The economy is a little shaky. The coronavirus and the market are both up, and we'll cover that and more today on today's Quarterly Context webinar. Welcome to WealthStep's Quarterly Context webinar for the third quarter of 2020. WealthStep is an online service designed to help 401k plan participants and other individuals make smart, long-term saving and investment decisions towards achieving retirement readiness. Quarterly Context has two sections to support disciplined, strategic, patient saving and investing to help you achieve your goals. The first section reviews the current economy and markets to put the short term into a broader perspective, plus investor behavior, insights, and more. The second section will give a quick summary of how to make wise decisions and the basics about WealthStep. But try to keep these webinars to 15 or 20 minutes, and please share it with others if you think they'll benefit. As a starting point, it's always good to remember to focus on the area between that overlaps where things that matter and the things that can control. So you have short-term events in the news and markets and in your life, and long-term plans and short-term plans. And it's in terms of your retirement readiness, the key things are to really focus on what you can control and things that matter, which are defining your goals, saving consistently, life stage investing, global diversification, and remaining a disciplined investor even when the market gets bumpy. So for section one, perspective for better long-term decisions. We'll review a number of elements, and there's also more information we provide through the blog and social media if you want more information between the periods we do these quarterly context webinars. As a high-level overview, there's always a lot of news in every quarter, and this quarter was no exception, whether it had to do with the status of the election questions that are upcoming, economic news, a number of things you can see here at the bottom. We want to go into detail there. We just want to show you how, for example, the coronavirus economy took a big dip. There's been an enormous recovery, essentially above or hovering around where it was at the peak prior to that. And if you put that into the broader perspective here in this longer term chart, you can see everything starts to look like a small difference. The stock market was very strong for the third quarter of 2020, with some returns as high as 9%, which is higher than what we would normally expect to see in a full year. So there are a number of factors contributing to that, including in some ways primarily the Federal Reserve's low interest rate policy and the heavy stimulation that has occurred despite and in support of the economy during the COVID crisis. You can see for the year numbers, also strong across several markets, and the year to date through the end of September was 5.6%. So still, even despite that large drop for COVID, quite a strong recovery at the moment. We put that market, that drop and recovery so far into perspective. If we'd attach that onto the drop and rise of the global financial crisis and compare that to three other markets to make up for the four bad bears altogether, that global financial crisis, the oil and embargo market of the 70s, the Great Depression, and the dot-com crash were the four worst markets in history. And you see how they compare here on an after-inflation basis, which is really the most interesting way to look at it, because an inflation-adjusted basis shows what you actually have left to spend relative to the cost of goods and services. And this current market through the last 10 years or so has been very strong, coming off of that difficult global financial crisis market. Volatility, as measured by the VIX index, is way up recently. It's come down a little bit since, but at the peak of the global financial crisis here, it's actually lower than the peak of the COVID market. So volatility varies over time, as you can see, and a more normal level would be in this lower range here. Again, big spike a few months ago. part of what's driving the volatility and some of the concerns, even though the market has continued to go up, is the COVID numbers, which have bumped around and are more recently going up again. You can see in the world, the numbers have ratcheted up. In the US, the numbers hit a peak and then seem to be cooling off and is now picking up again. There's some question about whether there'll be a new and higher peak, possibly, yet to be determined. And if we look at California as one example, more specifically, peaked and then has maintained a more stable number below. And here in the lower left, you can see a heat map of where the hotspots are around the country. Some of the concerns coming up are that there's still no clear timing about a vaccine, increased concern and confirmation about what's called aerosolization, or the virus floating in the air, which makes it a little more problematic, sometimes much more problematic in terms of contagion, since it doesn't just fall to the ground quickly. And as we are heading into the flu season, which tends to peak somewhere between December and March historically, with February oftentimes being the worst month, there's increased concerns about how that will combine with the COVID pandemic in terms of sickness and impact, and therefore questions about the economy. There are questions also about how long this recession will last. The Federal Reserve maintains a model that indicates how probable recessions are, and some of the current indications suggest that we may have already hit the worst part of it, but it's unclear how long this would last. Some economists are saying that it could last until 2023, until things are really more back to normal. That would be a lot shorter than the Great Recession's 7-year-long recession. There's still question marks, but it could be, again, still take a couple of years to crawl back out to a normal place. The yield curve, the bond yield curve, and not to get too technical here, but this shows the shape of interest rates across different bond maturities over time, and the shape of what interest rate is being paid on different bonds of different maturities oftentimes tells something about what the bond market and investors think about the economy. So about a year ago, there was what was called an inverted yield curve. That tends to happen where there are short-term rates that are paying more than medium-term and some longer rates. That tends to happen before some sort of recession. It's an indication that investors are concerned about the economy. It doesn't always turn out to be a recession, but more often than not, when it's inverted, it turns out to be a recession. Here, more recently and more persistently, the rates have been a more normal-shaped curve, however, are remaining very low, whereas normally in the middle of a recession, the curve tends to steepen, which would indicate higher prospects of growth. So the fact that the yield curve is remaining low suggests that there are lower growth expectations, and that has would suggest that the economy and the market may still have a ways to go to get back to normal. All of this fits within normal business cycles. This chart isn't saying specifically where we are now, although we're pretty clearly in this recession category. But there's a typical set of pattern of early expansion, maturing expansion, late expansion, and recession, and then it tends to cycle back to early expansion. And there are different stocks and different sectors of the economy that tend to do better than others in each of those segments. And that's one of the reasons that diversification in investing is so important. So while the market has been strong and the economy has made some improvements, we would encourage you to not quite take your seatbelts off yet. The GDP, or gross domestic product, officially dropped almost 33% in the second quarter. That was the steepest drop in over 70 years. The third quarter is projected to be up 24%. A more normal level of growth is in the 3% range, 3 to 4% range annually. But again, that 32 or 33% and that 24% are annualized quarter numbers, so it makes it look more dramatic than it is. Whereas the overall projected numbers for 2020 are expected to be for GDP to be down somewhere in the 6 to 8% range, which is significant economic impact, but not nearly as bad as last quarter's annualized number, and even next quarter's projected number won't get us back into the positive. A lot of those questions are driven by, about the economy, are driven by COVID and elections and stalled stimulus and other factors. Unemployment numbers are bumpy, seem to be getting some better at some points and then get a little worse. And so those are factors that are signs of the economy and that can also shape some of the outcomes depending on policy. If we take a look at a few charts, this is a busy slide. You can see unemployment really spiked up during the middle of COVID and then has improved, but still not back to more normal levels. Inflation has remained very low, which is actually historically a concern when it dips this low, because it means that growth is at a lower level of the economy as well. Consumer sentiment dropped off steeply during COVID and has picked up just a little bit. So it gives you some sense about some of the indicators of the economy here. Going back to GDP, or gross domestic product, that's really a measure of the economy's overall growth. And during the second quarter, you can see how it drifted down pretty dramatically. Normally this would be hovering around, a little bit above that 0% line and the 2 to 3, 4% line. So a pretty dramatic drop there. And there's some that we're projecting as the data and numbers came in. That's why these numbers evolved over the course of the quarter as to what the final quarter number might be for GDP for the second quarter. And the projections now have jumped back up. But again, these big jumps will still not offset this big drop, and so it's still expected to have negative GDP for the year. Then let's talk now about elections. Now that we're in the election season, and a lot of people wonder, what will happen, how will the outcome, and how will the market do depending on what party wins. It's always impossible to tell in the short run, but over the long run, there's really no clear winner in terms of which party tends to have stronger stock markets. There's also generally no strong opinions in terms of the market regarding volatility as well. It's pretty common if we measure volatility based on standard deviation, which is a statistical measure of the range of movement of something, like the market. On average, historically, it's been 13.8% before the market and 13.8% for 100 days after the market. So, that's another way to think about that is there's really no dramatic increase in volatility just due to elections on average. A little more on elections here. If there's any pattern, sometimes, if you see the all years return of going back almost 100 years, in election years, the returns actually tend to be a little bit higher regardless of party, a little bit higher than that very long-term overall average. Midterm elections tend to have a little bit lower returns. And then non-election years without any midterms tend to be better. So there's a little bit of uncertainty seems to dampen the markets a little bit when there are elections in general. Another interesting note is that when here we see orange is stocks and yellow is bonds. And when there's a new president elected, there's still on average is a positive return. And when there's an incumbent president or the same president wins the second term, markets tend to be a little higher. That's not about party. That's been the case across both parties over time. And basically what that says is the markets get a little nervous at first about anything that's new and different, regardless of what the party is. And so hold back a little bit in terms of markets, not knowing what the policies will be and how they'll play out. Now let's take a look at stock market patterns in the asset class corner. Basically what we're taking a peek at here is there are something called growth stocks and value stocks. And for those of you that are in 401k plans that have not only pre-built portfolio options, but also individual asset class funds, you might see that there are growth funds and value funds, or a whole bunch of different options. And just using this one example, Growth stocks tend to invest in companies that have faster growth rates, and value stocks tend to be those that invest in funds that are unusually cheap and out of favor and that may have a price rebound. In recent years, growth stocks have been on a run. In about 10 years before that, value stocks were in favor, and about the 10 years before that, growth stocks were in favor. So they take turns over time. So if you are in a 401k plan and are heavily investing in individual funds focused on growth, we may be at the peak of the cycle. Can't tell you when any given cycle will begin or end, but it may be wise to diversify. Generally, in the long run, is always valuable to diversify and hold a combination of both value and growth, as well as an array of other asset class investment exposures. Within the stock market, one unusual phenomenon is in the last number of years, there are 6 stocks you can see listed here, sometimes called the Fang Stocks, that have grown so much in size that they represent an increasing percentage of the overall market. So 6 stocks now represent about 1/4 of the overall market capitalization of the U.S. market, which is just enormous. And those same stocks, which have done very well in recent years, and that's part of why they've become such a large percentage, have outperformed. That doesn't mean they will always outperform, and it does mean that some of that market is maybe a little bit over-concentrated in some of those stocks. So beware of that what goes up can come down. And again, important reminder of diversification, even if it leads to returns that lag a little bit in the short run if you're more diversified. Another asset class corner element here. This takes a list of countries and shows which ones have had stronger valuations and other higher stock prices, and others that have had lower stock prices in recent years. This is, again, an argument for diversification, because oftentimes these countries, as do individual asset classes, that tend to take turns and rotate in and out of stock high and low stock prices over time. So when holding lower price stock countries can increase the value of portfolio when those return to being a higher price, and the higher price may go through the other part of an economic cycle and cycle back to having lower prices. So again, supports the concept of a diversification. There's some data as well that indicates, if you look at the mutual fund cash flows over time, what the average investor is doing. Some have been pulling money out of stocks and putting it into bonds and cash. That's not a recipe for great long-term results. And so oftentimes you want to avoid doing what the average investor is doing and just stick with your long-term strategy. There's something referred to stock valuations before. If we just look at, say, this upper left chart, you can see stock valuations go up over time, and when they've been up for a while, the market tends to cool off, and on the markets when valuations are low or stock prices are low, the market tends to go up following that. And right now we're at a relative high point, which would suggest that there may be some higher probability of the stock market cooling. This doesn't mean you should get out of the stock market. It just means this may help you manage your expectations if the market cools off at some point in the not too distant future. So now let's look at section 2, which is will be a recurring section. So if you've already viewed this video in a previous quarterly context, you can skip this unless you'd like a reminder. This is a little bit of an overview, and you can see the full financial education video at the top of the WealthStep.com blog page. So the key reminders for retirement readiness are to focus on aim, save, and invest. Aiming is about knowing how much you'll need and when in order to be financially independent and be able to stop working. You want to save the right amount. For many people, that's in the 10 to 15% range, but sometimes people need to save more or can save less if they're young enough or have already saved, might be ahead of the game. And then you want to invest in a way that is consistent over time and fits your life stage without being an emotional investor. So those are the key concepts, and the WealthStep website will help you walk through those elements in terms of its advice components. when that's available, which will be launching soon. It's always great to learn from others, and in our experience, when we've talked with 401k participants around the country, there's a bit of a pattern for a lot of people in terms of age. The younger people are, the more they think they should start later, and the older they are, the more they think they wish they had started sooner. So if you are in the younger category, it would be very wise to learn from those that wish they had just saved a little more or a lot more earlier, but a little bit more can make even an amazing difference in the long run if you do it consistently over years. There's a clear investment process that's used if you are in a retirement plan where WealthStep is used to build the pre-built portfolios that are in the plan. And if you're an individual WealthStep user, this same process is used to build portfolios. So the key point here is it's not a random process. There is a lot of research and analysis that goes into creating and designing a portfolio, maintaining a portfolio, formalizing an investment policy to maintain that over time, and then the ongoing monitoring and supervising. In terms of retirement plan basics, if you're in a 401k plan, I'm not going to walk through all of this here. This is information that you should discuss with and obtain from your employer. And if we are doing education meetings for your plan, we'll talk about the specifics. There are some things that are relevant to all plans because they are IRS rules, and other things that vary by the plan that the company can choose. So this is just a high-level reminder. And again, go to your HR department or the appropriate person at your company in order to obtain the specifics on your plan. Putting markets in context is important as well. As a long-term investor, you don't want to have expectations that are overly aggressive or unrealistic. And for example, markets have been unusually strong in the last number of years, and really the last 8-10 years since the global financial crisis, closer to the 15% range, where the long-term average last 100 years or so ago has been 10. And the projected return on average for the next 10 years, because of projected slowdown in the economy a little bit, is 7.2. So if you've been getting 15 and things come down to 7, that's actually a good number, and it will be bumpy. These averages are made up of highs and lows. So just a reminder of what normal is, because we haven't really seen normal in a while. And putting things into that long-term perspective in a line chart, you can see the benefits to, even if it's bumpy along the way, it is helpful, very helpful to hold stocks as some portion of your portfolio, generally consistent with your life stage. And WealthStep tools and your 401k education will help you understand what's appropriate for your life stage. And here we can see the result of some research that shows that the average return over the last 20 years was about 8%. That includes the global financial crisis, the dot-com crash, the COVID market, and the average investor in stock mutual funds, only 4.3%. That is ultimately because of what we call a behavior gap, where people got in and out of the money, in and out of their funds, out of concern, and ended up missing the recovery of the market. Sometimes people get out when the market's down, and that's really the worst time to get out, and then they miss recovery. So try to avoid emotional investing. Once WealthStep is fully launched and available to you, you'll be able to see this page, which is the Advice Center. The key elements here, it'll walk you through the planning, saving advice to figure how much you need and how much to save and how much you're going to need in order to be able to retire or stop working or work less. It'll help you figure out what portfolio might be appropriate for you, and it'll be very valuable to watch that educational video as well. And oftentimes sometimes watching the educational video is the best place to start, but I suggest with some combination of these three first, and then you want to implement the advice And then there are other resources and tools and information that may be helpful for you. In terms of how to access WealthStep, there are a couple of different methods. One is through 401k plans, where WealthStep has been brought in as a service. Your company is or would be paying for that. There are also ways to access it directly as individual investors, where you would actually have a portfolio managed as well as getting the online advice. There are certain minimums for that shown below. And there is a fee for that level of service. Then there's a digital-only service, which does have a fee, and that can be used for companies or individuals. And then there is a general public with the basic level of advice only, whereas the other levels have both basic and advanced advice. And there's no fee for that, and there's also no portfolio management. This is intended to help the general public to be a give back to help improve financial literacy and economic equality around the country. In summary for this section, remember to aim, save, and invest wisely. It's also important to spend appropriately, using a plan and within your means to make sure that you don't run out of money before you run out of time. And again, the full educational video is available on top of the WealthStep blog. Thank you, and we look forward to connecting with you again the next time.